You have some money, maybe $200 a month, maybe $500. And maybe you just got a raise or a tax refund and you actually have a lump sum sitting in your account. And you open your phone and start researching. Max out your 401k, they say. No, wait, Roth IRA first. Actually, pay off debt first. But what about the HSA? Someone on Reddit said the HSA is the best account available. And what about crypto, index funds, or an emergency fund? 45 minutes later, you close the tab and do nothing because every source you found was either too complicated, too generic, or contradicted something else you read. Here's the thing. This is one of the most searched financial questions. Where do I invest first? And it has a correct answer. Not a one-size-fits-all answer, but a framework so logical that once you see it, you'll never be paralyzed by this question again. Today I'm showing you that framework step by step in order with real numbers. My name is Yeng and I cover crypto, investing, and personal finance, including the foundational systems that most people never get taught clearly. If you want to know the smartest order to put your money to work, hit subscribe and give this a thumbs up if this helps. Let's build the framework from the ground up. Here's the data that perfectly explains why most people feel confused about investing. State Street's 2025 research found that a significant portion of retail investors struggle to prioritize which accounts to fund first. And that confusion has a real cost, not because people make terrible investments, but because they invest in the wrong order. The order you invest in determines your tax efficiency, your risk profile, and ultimately how much wealth you accumulate, even if the actual investments are identical. Two people, same income, same $500 per month to invest. One invests in the smartest order, one invests randomly, putting everything into a taxable brokerage account because it's the easiest to open. After 30 years, the smart order investor has approximately 20 to 30% more wealth. Not because they invested more, not because they picked better stocks, because they used accounts in the right sequence, minimized taxes, and captured free money that was available to them. The sequence matters as much as the amount. Before any investment account, before the 401k, before the Roth IRA, before crypto, and before anything, according to Ramsey Solutions, having a secure financial foundation is the key to building wealth. So, before you do any kind of investing, pay off all your consumer debt and save an emergency fund of 3 to 6 months of expenses. The math behind this is simple and the psychology behind ignoring it is even simpler. The average American household spends approximately $3,500 per month on essential expenses. 3 months of that, $10,500, is the minimum emergency fund. That $10,500 doesn't sit in a regular savings account earning 0.5%. It goes in a high-yield savings account paying 3.80 to 4.15%, so it earns while it waits. Here's why this step cannot be skipped. Without an emergency fund, every investment you make is at risk. A $1,200 car repair becomes a $1,200 withdrawal from your index fund. At whatever price it happens to be trading that day. You could be selling at a loss. You could be missing the best trading days of the year. You could be paying early withdrawal penalties. Think of the emergency fund as the insurance policy that lets every other investment stay invested. Once your emergency fund is funded, this is your next move, and it's the closest thing to free money that the financial system legally offers. Most employers who offer a 401k plan also offer a match. The most common structure, match 100% of your contributions up to 3 to 6% of your salary. You earn $60,000, your employer matches 100% of your contributions up to 4% of salary. That's $2,400 per year, They put in $2,400 if you put in $2,400. That is a 100% guaranteed return on your first $2,400. Before the market does anything, before compounding, before any investment ceases. Not capturing your full employer match, leaving part of your salary on the table. Here's what most people don't realize. This is not a retirement account perk, it is a compensation component. When your employer offers a match and you don't contribute enough to capture it, you are taking a pay cut voluntarily. The 2026 employee deferral limit is $24,500. At this step, you are only contributing enough to get the match. We will come back to maxing out the 401k later. Contribute exactly enough to get the full match. Not more, not yet. Then move to step 3. Here's where it gets really interesting because this step surprises almost everyone, including people who've been investing for years. The health savings account, the HSA, is mathematically the most tax-efficient account that exists in the US financial system. Number 1, contributions are tax deductible. Reduces your taxable income dollar for dollar. Growth is tax-free. No taxes on dividends, capital gains, or interest inside the account. Withdrawals for qualified medical expenses are tax-free. No other account does all three. The Roth IRA does 2, the 401k does 1, the HSA does all 3 simultaneously. For 2026, you can contribute $4,400 for individual coverage or $8,750 for family coverage. If you're 55 or older, you can add an additional $1,000 catch-up contribution. The best strategy for an HSA is to contribute the maximum, invest the balance, and pay current medical expenses out of pocket. The key move, contribute to maximum, invest the funds inside the account in a low-cost index fund, and pay your current medical expenses out of pocket from your regular income if possible. This way, the HSA functions as a stealth retirement account. By age 65, HSA funds can be withdrawn for any purpose, not just medical, and taxed as regular income, exactly like a traditional IRA, but any medical expenses remain completely tax-free forever. $4,400 per year in an HSA for 25 years at 10% annual return is $431,000 in completely tax-sheltered funds. The HSA is genuinely the secret weapon of personal finance, and it only requires one thing: enrollment in a high-deductible health plan. After the match and the HSA, the Roth IRA. The Roth IRA is funded with after-tax money. You pay taxes on the income now, but everything inside the account, every dollar of growth, every dividend, every gain, is completely tax-free when you withdraw it in retirement. You and your spouse, if you're married, can open a Roth IRA and max out your contributions there. The 2026 contribution limit is $7,500 or $8,600 if you're 50 or older. $7,500 per year in a Roth IRA for 35 years at 10% annual return. It's over $2 million. Every dollar of growth, tax-free. Here's a psychological insight that makes the Roth IRA powerful for younger investors. When you're in your 20s or early 30s, you're likely in a lower tax bracket than you'll be at peak earning years. Paying tax on your contributions now at a lower rate and then paying zero tax on millions of dollars of growth later is mathematically extraordinary. The Roth IRA income limit for 2026 is $150,000 for single filers and $236,000 for married filing jointly. If your income exceeds those limits, there is a legal workaround called the backdoor Roth IRA. Fund a Roth IRA using the backdoor method if your income is too high. You capture the employer match in step 2. Now, after the HSA and Roth IRA are funded, you come back to the 401k and push it toward the maximum. The 2026 employee deferral limit is $24,500. If you are 50 or older, you can contribute an additional $8,000 in catch-up contributions for a total of $32,500. Most people can't max their 401k immediately, and that's completely fine. The framework tells you the order, not the amount. Contribute what you can at each level before moving to the next. The 401k reduces your taxable income in the year you contribute. On a $75,000 income in the 22% tax bracket, maxing your 401k at $24,500 saves you $5,390 in federal taxes in that single year. That's money that would have gone to the IRS, now growing inside your retirement account instead. Once all the tax-advantaged accounts are funded, or you've contributed as much as your income allows, the taxable brokerage account is where the remainder goes. This is a standard investment account with no annual contribution limits and no restrictions on when you can access the money. The trade-off: capital gains taxes apply when you sell assets for a profit. The smart move here: hold index funds with low turnover like VOO or VTI for long periods. Investments held longer than 12 months qualify for long-term capital gain rates of 0%, 15%, or 20% lower than ordinary income tax rates. The taxable brokerage is unlimited. You can put $1 or $1 million into it. It's your open-ended wealth building account once all the tax sheltered boxes are checked. Here is the complete framework in order. Emergency fund, 3 to 6 months of expenses in a high-yield savings account. 401k match, contribute exactly enough to capture every dollar of employer match. HSA, max it, invest it, pay medical expenses out of pocket. Roth IRA, max it at $7,500, max your 401k, push toward $24,500. In taxable brokerage and limited, open-ended, low-cost index funds. This is the framework that financial planners spend $300 per hour explaining. You just got it in 12 minutes. The order doesn't change. The amounts at each step depend on your income, but the sequence: emergency fund, then match, then HSA, then Roth, then max 401k, then brokerage. That sequence is the smartest path through the tax code that any individual investor in America can take. If this finally gives you the clear picture you were looking for, please hit the like button. It helps more people find this content. Subscribe and hit the bell. I post every week on crypto, investing, and personal finance. Drop your comment below. Which step are you on right now? And what's the one step you're implementing this week? I read every single comment. See you next time. Bye!